Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Jamie Nemtsas and Meredith from Wattle Partners, how you guys going?
Yeah, good, great. Mate, good to see you again.
Yeah, last time we caught up, Jamie, you said, lucky this podcast is not recorded in video, but now it is. So here we are.
That's why I've got this beautiful filter.
Yeah, I wasn't made for video. So.
No, mate, you're being too modest. Okay, so this episode comes on the back of a really, really popular first episode that we did around portfolio construction essentials. So if you're new to Jamie and Drew, we've done lots of episodes together in the past, but the one in the past that's specific for this one was portfolio construction essentials, where we talk about SAA, strategic asset allocation, TAA, tactical asset allocation, basically everything that falls in around that. In this one, this is a really, really interesting one because you guys actually just both helped out my in-laws with their kind of pre-retirement / going into retirement planning and did them an SOA, which I was really impressed with. So I'm hoping that we can do another example, but we'll just pick like a kind of fictitious person or couple with a situation. And then I'm just going to prompt you guys, but I hope you guys can go back and forth a bit as we go through. So maybe I'll just dive straight into the background on this couple. So the couple is start with the male. We've got Craig. He's 62. He earns $125,000 a year as a mechanical engineer. So on PAYG. He's got $850K in super, and he's maximizing the super guarantee. He has a balance strategy and pays around $5,500 in insurance, which I think is pretty common. And his super fund has returned 6.6% per annum over the past 10 years. Fiona is 55, so she's a bit younger, 7 years younger. She's a BDM for a technology company, earning $110K plus $10K in bonuses. She's also on PAYG. She's got a hefty $670K in super, balance strategy, $3,500 in insurance every year. And her fund has returned 5.4%. Now, I'll just give you some other stuff around the situation. If you can't keep up, no worries. I'll put this all in the show notes so you can actually just have the situation in front of you as the guys riff on it. But so they've got $100K left on their mortgage, and the house is worth about $880. 2 adult-aged children who are self-sufficient. Both believe they are high-risk investors, but Craig is more so conservative, and he's interested in replacing his income with defensive options. The fees on their super funds are estimated to be 1.2% per year. They have $450K in managed funds, $300K in cash, so they've saved pretty hard. They estimate they want $80,000 a year to live comfortably. So that's like a key thing for them, is $80,000 a year. Craig's super insurance covers him for $190K, that's life and TPD, and his income protection is only $4,000 a month. Fiona's super insurance covers her for $260 life and TPD and $3,000 per month income protection. Finally, we'll get to the goals. So the goals, they both want to retire in the next 3 to 5 years and get advice from the two of you on things like these. They want to be debt-free before retirement. So should they use their cash to pay down any debt? Craig is thinking of buying an investment property for the yield just before retirement, so he can kind of have that as an asset that pays income. They want to build an investment portfolio capable of helping them live sustainably, but they don't know if their super fees and strategy are right. They want to have cash to feel secure so that they can maintain a decent buffer. They'd rather be hands-off investors. So just leave it to guys like yourselves to pick managed funds or EDFs and manage the super for them. And importantly, they don't want to leave anything to their kids. So,
I like that.
It starts that way.
Okay, cool. Maybe I'll start with you, Jamie, then. How does, if someone, so this is the situation, we've got Craig and Fiona, that they know that they've saved hard, but now they need to get smarter because they're coming into retirement. How does the financial planning process work at Wattle Partners?
Yeah, I think
Wattle Partners, it's very similar to every other financial planning firm. We of course start with something like this. So we ask the client, every other firm will be the same. They ask the client to fill in a fact find. So a fact find will be all the detail that you've got here plus more. So the first conversation can be relevant to them. We ask them to fill in a risk profile. So again, the whole industry does this. Fact find, do you understand the client? Do you understand the situation? And then risk profile. So they're typically 2 documents that are completed before a client would see an advisor. And it helps the advisor understand what they're looking for and how they potentially can be helped. Of course, it's just documents, right? So it's nothing about the nuances or the emotional elements of it or how a client feels. So but it essentially starts at those 2. Client will call up, we'll send out the documents will be completed, and then the client will typically meet. At the moment, it's over Zoom, but normally face-to-face to talk about these issues and how potentially an advisor can help.
Part of that questionnaire is also getting an idea of how they feel about different parts of their situation. So it is mainly factual, but how do you feel about your debt position? Do you think you have enough for retirement? And kind of getting the emotion in there as much as you can before you meet, because a lot of it is the mental challenge of getting to retirement, less so than financial.
Is this process, this first process, is this free? If they called you and say, "Hey, I'm interested in becoming a client. What's my first step?" Is this free? This first step?
Yeah, each advisor typically has their client base that they're looking after. So Drew and I are experts in pre and post retirement. So the majority of our clients come in at age 50 plus, and we help them for the whole of their retirement. If a client came to us and they're 25, we would probably struggle. Just the way that our business is structured, the way that our expertise sits in advice. So in that case, we would either refer them on to another advisor that was more appropriate, or just tell them that we couldn't help them. But if it's essentially somewhere, and we make sure that we communicate what we are good at and what kind of clients we can help. So
You're generally looking at initial chat, no cost. Then we'd send the questionnaire to set up a, it used to be an in-person meeting, but now it's Zoom or Teams. And with the questionnaire, you can be armed for that conversation. We'd have 30 questions like what we've got for this. Treat it as if it was a client meeting, got 30 questions that we think need clarification before moving any further.
Okay. What are some of the questions that you would ask?
Everything. So experience investing. I mean, some specific ones. Immediately I looked at this. You said they needed 80,000 in income. Be interesting to know how much they're saving at the moment. Where does this 80,000 come from? Does it come from a newspaper article? If they're spending 150 now, if they're earning 275 and they're not saving anything now, well, how are they going to change that? Yeah, when they retire. So
is that pretty common? Is that
very
pretty common that you
think?
Yeah,
and it's always sometimes hard. No one runs a real budget, so it's quite hard to understand. Are you actually saving money at the moment, and whether the 80 you've said is achievable?
And is that
because we do it so often, Owen, you always, the initial fact finder, Drew and I will look through it, and there's always things that are brought up that you go, well, I'm not sure that they've actually answered that. And it's a hot spot within the questionnaire. So they say they're a high risk investor. We've been through this concept that high risk investors, once they go through the traditional risk profiling, and typically it's a male thing that they come through and say we're high risk investors. Well, when you start talking about the characteristics, or hold their hands through a correction that might last 3 or 4 years, and the capital, what we deal with is every cent that people have saved through their whole life, right? It's every cent, and typically they've ended their ability to earn any more. So you've got a finite piece of capital that you've got to live on until you pass away. Now that, if you think about the emotions attached with that, it's totally different than, say, us three, and we can be high risk investors because we're getting paid every other week. So then, the high risk concept, when portfolios fall 25%, as portfolios do, how do they act? That's really, really important for us to assess early, and understand why they think they're a high risk investor.
The other kind of thing I picked out of yours was the profession. So one of them's an engineer. We've got a lot of, I won't overly generalize, but an engineer and then a kind of more sales person experience there. So you'd typically think the salesperson would have a more aggressive, having worked on a bonus structure or things of that nature, whereas an engineer in our experience tends to suggest things, 1 + 1 = 2, which we know in markets, it doesn't, if that's oversimplifying, but engineers in our experience tend to be more conservative in general, I think.
Well, it's a bit of an art rather than a science, right? So with an engineer or architect mindset, they're looking for a formula. And sometimes it's really hard, even though that we're in finance, so you would think a formula would work. It's strategizing about the rest of your retirement and how assets should be held is an art, and we've kind of perfected that art. Sometimes it's hard to communicate to people that are looking for a formula.
Just circling back to that 80K, when people come to you, they're thinking in a couple, is that, I just guessed, I just put that number out there, to be honest. I didn't really have a clue what I was doing. And does that sound like something people would come to you with, or do they often say a lot more or less, or where does that normally land?
I think it's probably sitting about the average that we see of what people think they need. And I think it does fit most, this environment, you're probably spending far less. Then you consider if it's in superannuation, it'll be tax-free. So you have to have that conversation as well, where they're talking about 80,000, is that before or after tax, because you're used to paying tax on all your income. But I think it sits around normal. What do they say? The stats say that something like 58,000 a year is a comfortable retirement for a couple. In our experience, probably the people we work with, is more like 80, but then it depends on the stage of your retirement as well.
Yeah, sure. And the pattern of income through retirement changes as well. We always say that typically a couple like Craig and Fiona will retire probably when Craig is 65, 66. She'll be early 60s, and they'll probably do a lot of things. So, maybe it's 80 to pay for the bread and milk and the expenses, but they'll probably renovate their house. They'll probably buy a caravan, go around Australia. They'll probably go for 1 or 2 overseas trips. They'll probably help their children into housing. What is the baseline? And what we typically notice is for the first 10 years of retirement, it's 80 plus capital, right? Capital for travel, capital for cars, capital. And then it drops right back. So sometime in your 70s, what I've noticed, I'll talk for me, not true, but what I've noticed is clients get old, and it doesn't necessarily start at retirement. We see clients on a regular basis, so they'll be one quarter and they'll be fine. Next quarter, they'll come in and you notice that they're now old, right? And typically then spending drops, and it drops substantially because all those capital costs for 10 years, and then they start having and this is what we specialize in. One partner will pass away, and then there will potentially be a change of house, and then potentially it will be aged care involved. So then income again changes substantially. Income and capital needs changes substantially in your 80s. So you see lovely charts all the time in financial plans that have, here's your income, and it's got this nice type of flow to it. That's not reality. I don't think it's reality to what we see.
And I tend to agree with you there. I see those charts and I'm like, that's pretty unpredictable when you start getting health things, travel. A lot of those things aren't captured in those models, right? So what are some of the... So just on that life cycle, before we get to some specific areas, what are some of the things that people do wrong at this time, like when they transition to retirement? Where are they stuffing up here?
The biggest mistake from a client's perspective that we've seen over 20 years is not understanding their tolerance to risk or loss and making substantial changes in crisis. We saw it last year, we saw it 10 years ago, we see it every time. It doesn't matter when people, and that's why we kind of specialize in this and specialize in holding people's hands really tight in this period. When you are retired, you have a finite, piece of capital and you see it fall, emotionally, it doesn't matter who you are. Emotionally, it's really, really hard, right?
You can lose a year of salary in, a minute on the market.
Yeah, that's right. So these people, for example, they're going to have roughly $2.5 million, maybe a little bit more by the time they retire. Markets could fall 10%, official correction, and they could lose 10% at $250,000. And their salary together is $250,000. So when people start putting these numbers together, it's the biggest problem. And it's not a problem just with our clients. It's a problem with everyone from an investor's perspective. You look at switches at industry funds, they peak at the bottom.
Right.
So
They typically peak at the top, where people then see the returns that they've provided, 20 plus returns in Aussie Super. You can see it, like last year, Aussie Super didn't do that well. So you're probably switching out for a safer option. So you've gone from growth to conservative. This year, you've got your statement that says 21%, and you're in a conservative option that said 3 or 4. So now you're probably going to switch to Australian Super without thinking about it. You're going to think about going to the balanced option in Australian Super from the conservative option. It's just intuitive. It makes kind of sense. But that's the biggest problem,
the big
that I see.
issue. Yeah, the one I see is probably where SMSFs are quite unique around the world. So a lot of people end up starting their own SMSF, taking control of their investments, but they tend to be solely focused on income. You'd see it with a lot of the people you interview as well. Like all that matters is income, but we know, history's shown companies that just pay out all their dividends like anything. They don't grow. They basically go nowhere, and your income is eaten up by capital loss effectively. So I think the risk and that fits with Jamie's what their tolerance is to risk. A lot of people take more risks than they actually realize, and only look at the income that's being produced by their portfolio, because I think that's the only thing they can pay the bills with.
I think education is a key. I mean, what your whole business is about, Owen, is empowering people through knowledge and education. So a lot of people don't have the knowledge and education to essentially manage their portfolio, or even emotionally know how to respond to it. And when you couple, you're 65, and there's a great transition at retirement from being really, let's take, a lot of our clients are senior execs, really important people. They have PAs, they have a whole team looking after them. They're retired. There's great fanfare. They go home and they're not important anymore, right? So then what do they do? And a lot of them start trying to get involved in their investment portfolio and try to learn more. But if you haven't learn over a longer period of time, it's a really hard thing to learn and invest when, again, you've got this finite piece of capital that you're trying to live off. How do you learn at that age? And the emotional effects of making wrong decisions totally affect the way you see things. So we see a lot of people try to learn a lot more, but I think in a lot of cases it's too late.
I've heard of a lot of stories of people transitioning to retirement and have the SMSF for 3 years, and then they forget it. Like so they lose interest, or they get shook out of it, like you're saying, and that leaves them in a worse situation than what they would have if they just took the advice and just kind of stayed away from it. Can I just jump into some of the key points here? One of the goals was that, well, not a goal necessarily, but they're not sure if Craig and Fiona need insurance. So, I think I've got in here, Fiona's insurance Inside Super covers her for $260K for life and TPD, and income protection of $3,000. Craig's is for $190 of life and TPD, and $4,000 a month if he draws on income protection. What are some of the factors that they should be considering when they think about their insurance needs?
I think the main reason you have insurance during your life is to pay off debt and to make sure your family isn't impacted. If you're raising children, or if you've got a mortgage, if you were to pass away and you can't earn an income, you're not providing an income, you want your family to continue as they were as much as possible. So I think, do you have any debt? Do you have any ongoing expenses that can't be covered by other assets? Are probably the two most important things, Jamie.
Yeah, I think, we, again, as a firm that specializes in retirement, typically cancel more insurance policies than we ever write. And this couple, if you look at their net assets, take away their minor debt, if one of them was to pass away, they would have enough assets. If one of them was to become incapacitated, they've got enough assets. So then we would suggest, and your numbers here, we've seen a lot worse, where people are trying to save for their retirement, but insurance premiums are more than the money they save every year. So they're actually effectively going backwards by paying for a contingency of what if. So sometimes you've got to evaluate that.
Part of that
Yep.
question is, do you have enough to retire at the moment? So it's
Yeah.
almost the chicken before the egg. If you've got enough, why would you ever insure yourself if you're already ready?
So generally, Australia's overinsured, right? So we would take the view, and doing this for a long time. I'm a bit older than Drew.
I'd probably say
Long
those
time.
with insurance are overinsured, but there's heaps of people that are underinsured.
Sure. But we don't see them every day, right?
Yeah.
Our clients are typically like this. They'll come to us to have an insurance policy. It's been in place for 10 or 15 years. It's a stepped insurance premium, e.g. it goes up every year. They haven't reviewed it. These people, for example, in my opinion, wouldn't need any insurance. I would cancel all of it. And I would put it towards building a bigger portfolio over the next 5 years. If you take the premiums and invest, I think it's a better outcome. It's not necessarily the word self-insurer. It's not really self-insurer. They've got sufficient assets to cater for it. The other point I want to make is in what happens after death. And I've seen it a lot with clients where it's not another linear example. People go, okay, will I have enough money living in the same house, in the same way, in the same environment, and I won't repartner. And, that is rarely the case post-death of a partner. Within 3 years, typically people have changed their housing, potentially repartnered, and the situation again isn't linear. So what are you designing, and how much insurance do you actually need? And that's a really important thing that we participate into, post that death of a partner, reevaluating all your options and what you're spending on housing, and, what does your portfolio look like?
Do you have any strategies with that? Like, can you anticipate any of that? Like, or is it more so just being having like a sound position?
Again, when we do insurance assessment, there's lots of straight line formulas that would do insurance assessment based on that, right? But it's realistically, if your advisor is good, the advisor will think about, well, what ifs? What if, do I need to make sure that you have a house, a holiday house, and a country house if your partner dies, and should I cover all that? I mean, a good advisor will go through the what ifs and think about what is an appropriate level of insurance, especially in their 40s and 50s. And I think that's, the value of a really good advisor, is that they can think about the alternatives.
Okay. One of the things that Craig wants to do is kind of focus on that income piece in retirement. So again, the 80K is kind of the ideal, but he's heard in the grapevine, probably read it in AFR or something about investment property and whatever. He's thinking of buying a residential investment property for yield. Where they are right now, do you think that is a good idea, basically?
It's a difficult question, isn't it? You look out the door and residential property is going crazy. But in our experience, what's the after cost yield? It's usually about 2 to 3%, which people kind of forget about. So going back to the part before, is you don't want to invest solely for yield. So it's important to separate the kind of investment consideration into what total return do you expect from that asset. We obviously have some bias because we don't advise on residential property. We advise on building diversified portfolios of multiple asset classes. personally, in our experience with, as a comparison to a 2 to 3% from a residential property point of view, a balanced portfolio can easily generate an income of 4 to 5% across multiple asset classes, without some of the holding costs, without some of the same, risks like stamp duty, tenants, repairs, all those sort of those issues. I mean, I personally prefer equities because I can sell them and buy little bits of little different businesses, and all those things will work differently depending on the economic environment. Jamie probably shares the same view.
Yeah, I think of the driver. So back to Craig and Fiona, they've chosen to retire. They've got a good nest egg, but they've chosen to retire in an incredibly hard period of time for the next 30 years to manage their capital. Rates have fallen for 30 years, and any asset that has been valued off rates has gone up. Real estate's one of them. Shares is probably another. So anything that gets valued off a risk-free rate has gone up in value over 30 years. Now, if we've got a finite pool of capital and we're trying to manage that over the next 30, we would have to put some assumption that rates are going to go up at some point.
I disagree with that.
At best, sideways. Let's build Drew's view that it goes sideways. The risk is up, right? So probably firm's view is it goes sideways, but the risk is up. So what happens?
30-year retirement, yeah.
What happens if rates go up? Then assets go down. That are priced off the risk-free rate. That's as simple as economics is. So that would mean, okay, how much do you want in that asset class, particular asset, and what potential hedges can you get against rates going up? So what kind of inflation hedges can you get? So
what are they? Are there any?
Oh, if you had commercial lease, so typically residential in Australia, unlike the rest of the world, is a short-term lease, 6 months or 12 months. So therefore, very hard to hedge against inflation. So if you've got a commercial lease, a 5 to 7 year commercial lease, typically you have an inflation hedge in that. The
infrastructure assets, commercial property, companies that can you probably discussed them many times, companies that can pass on costs to consumers. So all
this
these
is
things,
inflation hedges,
yeah, for inflation hedges.
Timberland, gold, they're all decent hedges.
Crypto, maybe still.
But so again, it's hard, right? Residential.
Yeah.
What is really important, what we're trying to get people to think about is what drove returns over the last 30 years, what will drive returns over the next 30, and don't get caught. Just don't, rates, the risk is rates go up. Now, maybe our thesis is to go sideways, but if they go up, asset prices will go down without any issue at all.
It reduces your flexibility too, is what we see. So if they've got 2.2 in investable assets, they're probably going to spend 800 or so at least on an investment property, if not more, which means, it's at over a third of your asset base goes into a single illiquid asset, which makes sense. Some people might be comfortable with that, but I think it doesn't give you much flexibility if you want to buy a holiday house, if you want to change plans, or really you're just stuck in this one. Most of the time, particularly at the moment, most of the returns from property come from capital gains. As Jamie was saying, if interest rates are higher, then your holding period just has to be longer for a property.
What we've found is a lot of people hold a lot of property in the accumulation stage, right? And they have 2 or 3, typically because they are really comfortable holding large amounts of debt against it. People will go and buy 10% equity, 90% debt, and feel really comfortable about that asset. If you think about it, it's crazy. But they'll feel really comfortable about it, and then buy a second one and a third one, and then they've got great exposure to a growth asset. Then interest rates fall off, so they make money. But it's a lot of work. Agents, tenants, repairs, taxes, income. And what we find generally, without us even influencing the decision, a lot of people get tired of it, right? They want a retirement that is a lot hassle-free, and there's great, even if you want real estate, there's great options to go into real estate through pooled funds or listed versions or syndicates, and there's some great providers out there that give you some of the elements that you want in real estate without all the work, professional management over a good asset.
Yeah, because my question follow-up to Jamie, because you mentioned before about commercial leases. We actually had Andrew Swartz from Qualitas on the show not long ago, and he was taking us through that. And I was surprised by how low duration those leases were, but also how consistent the yield was, because I think a lot of people like a property too, because the rent should be at least every single month. Like it's predictable. I think that's what people value as well. Can you still get that from, by not having a property?
Sure. Just a plain ASX listed company will have 2 dividends per year. A lot of the property syndications will pay out monthly or quarterly. So we're not necessarily in portfolio design part of this yet, but one of the things is, why do you want regular income? Why do you need it monthly? You're probably not going to live hand to mouth in retirement. There's going to be some kind of pool of capital there, and that pool of capital we use for a number of different things, and one of them is to make sure the client always feels really safe, so they don't make those knee-jerk reactions when markets fall. So how many times your annual income do you want in assets that won't fluctuate with the market? So then you're not saying, oh, okay, this month I've got a pension. That's not necessarily how we approach it. We would approach it somewhere between 2 and 5 years of assets sitting in non-market linked assets, term deposits and fixed income, so the client feels comfortable, rather than trying to comfort the client by making sure the dividend is paid.
I think it's educating that total return. So we had a perfect example of last year. We just reported quarterly, which in our quarterly reviews, we showed people what their income was, what their franking credits were, what their total return was. Last year, their income fell by something like 40 or 50%. You only had to look at all the dividend cuts last year, but your total return was on average, 17 or 18%. Does it really matter if you only got 1 or 2% income last year, when you've got a portfolio that's worth 16% more, and you can easily manage that into cash flow rather than solely relying on the dividends and payments coming in? So it's a big education process. So it's what we do every day.
For sure.
And
okay,
Drew kind of highlighted it before. There's been lots of mistakes in retirement where people have seen, say, if the total return equation of your portfolio is total return equals income plus growth, a lot of DIY investors have really chased the income. So once you chase the income over what is normal, 70% of the time or 80% of the time, there'll be something fundamentally flawed with that investment that's not being seen. Financially engineered, or a deep value investment that just gets deeper value over time, or they're in the wrong industry, or technology's disrupted them. Typically, and you've talked about this a bit, Owen, about value traps and income traps, but typically there's 70% of the time there's something that hurts the investment. Now, what happens is the capital then falls off, right? So you invest into it for a 7 or 8 or 9% return, and it's one of those 70%. And what happens is the capital falls off by 50%. So does it really matter? You got 7 or 8% for 4 years, and then your capital is halved? Not really. I mean, you'd rather investment that was still the same, paying 3 or 4%. So
there's a good chart that someone did of CSL versus Telstra, not Tesla. That'd be a good one, which compared, CSL that reinvests something like, I think it was $1 billion a year into R&D, versus Telstra that pays out 98% of earnings as dividends. You chart them over the last 10 years and everyone knows what it looks like. You've compounded 10, 15, 20 times in CSL, and Telstra is still below where it was 15 years ago. And it just investing for income doesn't necessarily result in the best outcome.
So it's a balance, right? So income plus growth, balance it up.
We like Telstra and CSL, so
we hold both.
Okay, so let's move into the investing component specifically then. Just want to circle back to something just at the top. We talked about risk profiles, and Craig was probably slightly more conservative, although they kind of both identified as high risk investors in their mind. What goes into that, I guess, that calculation specifically? And you said, Jamie, that the males often tend to be high growth coming in, and then they do the profile, and may not be the case.
I'd say most people would do our questionnaire. Very few actually come out as the very high risk as well. They're all very close to the same sort of risk level. You know, it's like the questions are like comparing yourself to others in terms of risk taking. So, yeah, I think it's much more. Everyone seems to have a similar view on how much risk they're willing to take. Maybe that's just because we're working with retirees and they kind of see how important their capital is.
Okay then. In terms of their super funds, which is a major portion of where they've got their capital tied up, and they will have for a long time. And I know this because I read one of your SOAs recently. What are some of the strategies that the two could use to boost their super balance?
Want me to take this one?
Yeah, go
Sure.
through.
And there's first thing I'd say is super, regardless of what comes out on the budget every year and all the political and media noise, super is by far the best entity structure to put your retirement assets in. How much you contribute if you're younger is a different story, but when you're this close to retirement, ultimately you can draw a tax-free pension once you retire, and the fund itself actually doesn't pay any tax within it. So in our view, it should make up the majority of your assets in retirement. There's two main ways that you can get money into super. So non-concessional contributions after tax, which are after tax, from your offset account or from your investment portfolio. They've just increased slightly to 110,000 a year as of last year. But you are restricted from making them once your balance reaches 1.6 million per person, and they're always per person. There's always some confusion about, is that contributions as a family, and the other option is concessional contributions, which are your super guarantee. As you kind of alluded to in there, I think one person was using them all up. That's 27,500 per year. The majority of that comes from your super guarantee that's deducted depending on who you work for, if you're self-employed, and you can actually top them up each year up to that 27,500 as well, and claim a tax deduction.
Okay.
There's, I think you kind of alluded to, co-contributions, spouse contributions. I think in this case, their income precludes them from accessing those. But for those with lower taxable incomes, I think it's under something like 75K, you can put in $1,000 and the government will pay an extra $1,000 into your super fund, which, what do they say? It's 100% return, free money. So if you can get that, it's worth getting it. And then spouse contributions are, $500 offsets for $3,000 contributions, but also tested against your salary. So in this case, they wouldn't, I think, unlikely to be able to access those.
Yeah.
So maximizing, reduce the insurance premiums, maximizing the before tax contributions for both of them.
One thing you can do is actually transfer your existing investments if you are running a SMSF or multiple different types of platform super funds. You can actually transfer your existing investment portfolio as a contribution in a lot of cases. Obviously, capital gains when you're selling those assets, but another way to get more money into super.
So it's taking their managed funds and their shares, and putting it into their superannuation fund.
Yeah. So that we've already covered this, but you would advise this couple not to take an SMSF. They did say they want to be kind of hands-free or hands-off. So
I think that would be determined once we sat down and talked it through. And it depends. There's lots of options. Self-managed super funds is just a vehicle. It doesn't necessarily mean it's always self-managed. So the majority of our clients have self-managed super funds, and we do the management for them. The way we service our clients is that we do quarterly reporting. So them as trustees would receive our reporting and our recommendations, and it's non-discretionary. So they sign it and send it back or they have a meeting with us to talk about various things. The benefit of that type of model, and lots of advisors have got different models, is that sometimes clients want to be really involved in the process, and especially in when markets fall a long way, they want to be in the process. And then sometimes, they want to holiday in Italy for 4 months and they don't want to be involved, right? So if you've got a process where with your advisors where you can be involved, or you can back out and not be involved, but you still know that there's a real system and a framework being executed, then that works for self-managed super funds. Now, so we've got a bias towards self-managed super funds. We like the structure. We like pulling everyone's investments together. We like holding a combination direct and managed and direct investments. But there's lots of options. There's a somewhere in between an industry fund and a self-managed super fund called a wrap account, and the wrap account fees used to be really high, but they're falling quite quickly. So potentially it's called an investor directed portfolio service. So that's another mechanism that we use for advisors for clients, so they feel like that they've got control and that they've got transparency, but someone else is doing the administration and the reporting. So
big part. So this is where in the initial meeting we discussed these and try to find out what their priorities are. Is it about keeping costs low? The SMSF Association put out a paper that said a balance is above $500,000 in super, you're typically going to be cheaper in an SMSF, depending on how you invest after that, as a separate decision. But it's what do you prioritize? Are you just prioritizing cost? Do you want some control? And do you want to have any time involved? So a two-way discussion. And then the outcome of these meetings is a statement of advice where we actually compare what we're recommending and the alternatives to that, including what the costs are. So you get an idea of and the costs and benefits. So
in this instance, Craig and Fiona say they've got 450k in managed funds and shares, as well as 300k in cash, which seems high to me. Would you suggest that they make non-concessional contributions of that 450, or like just as a general stroke, I guess?
I mean, given their Craig 62 retiring, one, assuming they don't have any major, expenses or unexpected things coming up, you always want to keep a reasonable cash buffer, and you need to be wary of preservation. So you have to meet certain age and other requirements to access your super completely. I think I don't have a date of birth, but I'd say it'd be 60 that Fiona would have to be before she can access her super, whereas Craig would probably be able to access it if he retired. So balancing that, we'd generally say, yeah, it could be use the maximum each year in the 3 years to your retirement.
Yep.
If that makes sense. But generally you want to have as much as you can into super before and during retirement.
The low hanging fruit is pay off your mortgage. They should just pay off their mortgage with their cash, right? So they have cash and a mortgage. So that makes sense to me to pay it off, and then think about maximizing their superannuation. But acknowledge the things that Drew talked about, access.
So Jamie, could they keep their mortgage and use it as a line of credit to invest or anything like that, or is it not really appropriate for them?
Yeah, we do often tell clients to pay off their mortgage, but leave the mortgage with the bank with the ability to draw. Once you get to that, once you're retired, then the bank sees you as a totally different person. So it's harder to get a line of credit. It's harder to borrow against a property, especially if you need it for cash flow purposes, or if you need to help your children or whatever. If the cost of holding the mortgage is relatively small and there's no line fee, then it could be a good idea to hold it. They definitely wouldn't borrow to invest with the level of capital that they want, measured by what outcome they're after. They're pretty close. So why would you want to do that? It's not like they're doing a catch-up strategy, or there's no real need to do it. But just that contingency, just in case, you might just leave it there. That's available.
Drew, if I'm just going to use this this is an example, it doesn't necessarily apply to these two, but if they were a high risk couple, what kind of allocations would you guys have in terms of like risky assets versus conservative assets or defensive assets or whatever?
Yeah, so the highest risk, just putting it out there, would be something like 10%, very little in low risk investments like cash, and 90% in everything, equities, property, anything. We consider assets being risk or no risk.
Would you consider their primary residence as an asset in that calculation?
No.
Okay, so it's like a lifestyle asset.
Yeah, we're more looking at the investable assets and how they should be allocated, because they're the ones generating the income. I think in the discussion you'd consider their total value of their assets, because they may downsize, they may upsize at some point as well. So knowing what their total worth is can give people comfort as well. If you got $3.1 million of assets, sounds better than 2.2 in just investable. So I'd say the only people that come off as a 1090 or a high growth or high risk, me and you probably aren't even there. We know too much about markets to be 1090, but you generally, the first thing you'd say is you'd have a discussion about, are you really comfortable with the level of historic drawdowns from a high risk portfolio? Are you comfortable with that compared to the alternatives? And I'd say it'd be much more closer to a balanced growth. They all sound very similar.
What would that be in terms of allocations?
So typically we'd view a balanced as being 50-50, balance between low risk and risk assets. You're probably sitting halfway between those, I think, for this sort of couple where, they do need both growth and income. And that's, don't set the risk profile without giving consideration to what sort of returns and they actually will need over the next 30 years.
Yeah, so the risk profiles feed into the asset allocations. This is really generic, Owen, but essentially 50-50, 30-70, 10-90 are the three asset allocations that would be, or risk profiles that feed into asset allocations that would be considered for a client like this. They're probably a 30-70, 30% in low risk assets, and 70% in growth assets, just generically what we would recommend.
Do you ever come across, just as a kind of left field question, do you ever come across people that have like really, really, really conservative to the point of it's kind of crazy that they ended up, they're at this age and they're so conservative? Do you ever come across those clients?
Quite a few.
We come across all types. So,
and ones that don't understand how aggressive they are as well.
80-20 in the opposite direction. So like 20-80. Like, do you come across that kind of stuff?
We come across this barbell strategy a lot, where people have lots in low risk, like cash and term deposits, and nothing in like property and equities, and then just a whole heap in big risk stuff, private
and
biotech startups, and then they like that, which is an interesting kind of concept to think. You don't need the stuff in the middle. You take all your risk here and your securities there. It's changed though, Owen. The risk-free rate being 0.5%, term deposits paying you nothing, has changed from just 10 years ago. I wrote an article in 2010 on a 50-50, and half of the portfolio was in term deposits rolling over 5 years. And that portfolio, that half of your portfolio was earning 6.25%, right? That's 10 years ago. So you're pretty comfortable in holding half your portfolio earning 6.25, where now, what would you earn, Drew? You wouldn't earn 0.5%, would you, on a 5-year rolling term deposit portfolio? So, people have had to take more risk. They've had to say, okay, how do I take more risk? Now, it's another thing that is facing lots of investors that are retiring today, is how do you get that 30% into risk-free assets. Cash and term deposits don't pay much. Then you have to take some credit. What type of credit? Do you move up to mortgage trust? Do you do direct lending? Does that essentially all come unstuck like it has previously at some point? So there's lots of issues in portfolio builds at the moment.
We kind of take the starting point of, can you put it all in a term deposit and live off the income with confidence that it'll still be there at the end? And the answer at the moment is no. If we could get term deposits at 6 or 7, then we'd put all of our clients' money in there. But now it's 0.5, so you have to take, as Jamie's saying, incremental risk and try and balance that towards both goals.
Hey, actually, speaking of returns, it reminded me of a question which we spoke about briefly off Jamie, which is Fiona's super fund has returned 5.4% over 10 years and Craig's has returned 6.6%. One of the questions my in-laws had was like, what's a good return from a super fund over 10 years, like a balanced fund?
Are you asking me that, Owen?
Yeah, I'm asking you.
Can I defer? And
going to defer to me.
Yeah, Drew.
I mean, there's a few benchmarks around. There's a bit of an issue in all of the superannuation industry, us industry funds everywhere, that everything's named differently. So a balanced fund here could be an aggressive fund over here. Won't name names, but a lot of balanced funds have 90%, as we were saying, in it, like an aggressive strategy. So understanding what your asset allocation is and what to compare with is the first part. I just looking at that, a balanced portfolio, you're probably, so Morningstar is the research group we use that has an average return, as well as Chant West, which is, I think, broadly accessible. They're sitting around 7 to 8%, I think, over the last 10 years, or 6.5 to 7.5%. Would be the average, whereas most of the reported things are like 9 or 10%. And it's important to, like, every superannuation strategy has to have an objective return, so that's probably more important to consider. The objective return of a 30-70 balanced is something like CPI, so inflation plus 3.5 to 4%. And if you think 3.5 or 4%, and you've got 6.5%, that's 2.5% inflation if it existed. So they're really in line with objective at the moment, if that makes sense.
Mm-hmm. Jamie, I'll give you one I know you've thought about a bit, which is when you sit down with clients, do you go over the ESG factors? So, air quotes, ethical investing, but just even, the environmental, social and governance frameworks with them and what they care about. Is that something that's increasingly playing a role in conversation?
Sure. It's relatively new in the client advisor relationship. Now, we'll say we've been doing it for 20 years, but most people we've come across over that period, if you offer them a capitalistic outcome in expense of the environment, they typically will take it. So, and I've seen it in the institutional world too, where ESG has grown quite rapidly, and it seems to be now a part of most good fund managers' process and corporate. So clients will come in. ESG is so personal though, of what people believe in. Is it, if you think about just the concept of ESG, it's environmental, which can be so many subsets. It's social, again, subsets, and then governance, which all good businesses should have great governance. So the easy bit is exclusions. I don't want to invest in tobacco. I don't want to invest in nuclear. I don't want to invest in. They're easy. And then you get into the positive screens, doing good for the economy. The environment. They're harder. So everyone is rushing to be green. Every fund manager is rushing to be green. How does that transcend into the underlying clients? We're seeing a bit of demand. We would say that we're at the forefront of building portfolios that do consider ESG, but it comes down to the individual, and what they want and what they want to achieve.
We're a member of the RIAA, which is the Responsible Investment Association, which has a pretty good tool that talks about the positive and negative screens and assesses a lot of managers as well. but it's a big part of conversation. So every one of these initial meetings would include the consideration of ethical.
A good way to explain it, Owen, is that 3 years ago, we had clients would come to us and want ESG, so we'd have an ESG portfolio, and some clients would come to us and didn't have any ESG issues, so they would have another portfolio. Where we don't hold that anymore. We kind of have one belief in terms of what portfolios should look like, and that encompasses everything ESG, right? When we go through due diligence with fund managers, there's a big ESG question. What's your beliefs? What memberships do you have? How do you execute it? Is it true to label? And our model is now greener, if you want to use the word greener, than it was, and it will continue to get more and more green in its approach.
Are you guys? Are you guys a B Corp?
Yeah, one of only a few companies that are B Corp, and we've been B Corp for a long time. B Corp is a movement that started before this real ESG green push. Essentially, it's a group of companies, started out of the US, but a group of companies that believe there's more, the companies should have objectives that are just not financial. So there should be, community-based and environmental-based as well. So every 3 years we go through recertification. It means, we've got a commitment to what could be loosely described as, a platform for ESG. So.
Yeah, it's pretty. I've heard the audit process is pretty intense to become a B Corp. Yeah. So that's great.
That's good.
Yeah. Okay, so just in summary with these guys, Craig and Fiona, were there any kind of key risks? We've only scratched the surface of them here, but were there any key risks that you guys pulled out of it? Anything else you want to add?
You go, Drew.
So the big one was what I almost said at the start, was making sure their income expectations meet what they're doing at the moment, and that risk profile and matching that particularly to the professions as well. So kind of anytime there's high risk, you have to really game the questionnaires that we provide to get to that level. So just delving more into that. But I think what we'd say to them is they're in an incredibly strong position. The big thing is going to be minimizing mistakes over the next 10, 15, 20 years, whatever they happen to be.
That's 100% right. What advisors aren't recognized for doing, which we do a lot, is stopping clients from making a mistake, and mistakes are costly. Wrong asset allocation, wrong investments, skewing at an inappropriate time. So, the value of an advisor should easily be measured by the money they save you from stopping you making mistakes. And we've been through the process so many times in a life cycle, so many times. It's not funny. We've seen estate planning, which we haven't covered here, but it's something we should cover off on, and we would cover off on in an initial meeting, is, we've seen estate plans that have been created, executed or implemented, right? So passing away of a partner, and what does that mean, and how there's a lot of concern so the founder of our business, Austin Donnelly, he founded the Australian Investors Association, which is a group of investors essentially trying to help other investors become better investors, right? We've always been associated with that, Drew and I, for 20 plus years. And it is a lot of those people that have got to retirement and they want to use investing as their hobby. So they join Australian Investors Association. All they talk about is investing, typically male dominated. And what happens in their 70s is that they realize that they've learned what they need to learn. That's their hobby. But what happens when that key decision maker, passes away? So in a lot of circumstances, we're the advisor that will get appointed on them passing away. But this plus last 30 years of your life is really difficult, right? Because it's not just like you're going to get unwell, you're going to have concerns, there's going to be family issues, you're going to have potentially draws on your capital for various reasons. And it's something that all we do, right? So we've seen most cases before. Problem children and grandchildren, we're nearly experts in them, because most families have, a special situation in their family that needs to be cared for either through the will or special trusts, or needs to be handled from a family meetings perspective. So by buying an expert, that's what you're doing by coming to us or some other group. Then that's that we've seen it before.
Yeah, makes sense. So on that, then how do people find you guys if they want to start this conversation? It's the best place for them to go.
We've got a website, wattlepartners.com.au. If you're interested, you can. There's a part in there you can put your details and email. It'll email to Drew or I. And you can email us directly, Jamie or Drew at wattlepartners.com.au.
Yep, I'll put links in the
happy
show
to.
notes too. Yeah,
I think
cool.
I still do the daily update for Rask
every day you can. Yeah, every day. Drew's up early in the morning.
Inbox.
That's a great read too. I don't do it, but I enjoy it, Drew.
Before the toddler. I've been trying to cancel it forever.
Yeah, you don't need to do anything else. You just read his update. He's done it for you. So yeah, great. Wonderful, guys. I really appreciate your time. And I think this will resonate with a lot of our listeners who maybe even if they're not this far along, if they're still just thinking of retirement and seeing an advisor, or even if they're in retirement, there's a lot of value from this. So next time I'll give you one a bit more challenging.
Yeah, we can do it every 6 months or every quarter and just change the circumstances. So people might get more out of that.
Yeah, for sure. Cool. Thanks, guys. Really appreciate it.
Thanks, mate. Cheers.
Thanks for having us.